Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about Twitter. Symbol is TWTR. Today we'll discuss, did we score or did we fumble? Hello, everybody. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, on Monday's Stock Play of the Day, we talked about Twitter. Twitter is going to be announcing earnings on October 29th. So we looked at a diagonal spread with calls being a little bullish. As always, we don't really pick direction here on the Stock Play of the Day. We're just talking about strategies that might apply given the conditions that are going on right now in an underlying stock. So the trade that we looked at was a diagonal spread with calls, and we mainly did it because of the way volatility is playing out going into this earnings event. So on my screen right now, I'm showing you inside the Ally Invest Options Playbook. We are showing the diagonal spread with calls. It kind of gives you a little bit of an explanation. It's a more advanced strategy, so I'm going to highlight it inside the book if you'd like to learn more about it. Now, we had a very interesting development this week, and whenever we talk about these trades, we always try to frame them as paper trades because, especially when you're talking about an advanced trade, and I think the most advanced trades in the options world don't have anything to do with the number of options you're trading in the strategy. The complexity comes in when you're dealing with different expirations within the same strategy. So on a diagonal spread, ideally, here's actually where the name came from, is that on the floor of the Chicago Board Option Exchange, all the market makers standing down in the pits, they have quote boards across the top. And the way the quote boards are listed are based off of expiration. So if you are selling an option contract with the near-term expiration and buying an option contract with a further out expiration, you are looking diagonally on the board. And that's hence the name diagonal spread. And that's where it comes from because of the way that the quote boards were set up on the trading floor of the first exchange that ever started trading listed options, which is the Chicago Board Option Exchange. Okay, so diagonal spreads with calls. I digress. The good news is that we have something to talk about and that the trade went against us. So we have an adjustment. And also the good news is that because we set up the trade the way that we did, it didn't hurt us that bad overall. So what happened this week? A lot happened, honestly, over this short period of time. I'm showing you a chart in Twitter. So I looked at Twitter here on Monday. This is a 15-minute chart. So we're seeing an entire day's worth of trading. We always tape the Stock Play of the Day at noon Eastern time on Monday. So on our chart, here's noon Eastern time. I've drawn a ray across where approximately the underlying stock was at when we were talking about it. It's a live show, so the stock is all over the place. But we see here it was right around 45.50. After the show was done, the stock actually made a little bit of a run up, a little bit of a run down, nothing that would have actually raised our concern. But we did say that if the underlying stock gets to our short strike in the near term, which was 47, that we should probably think about closing it out. And we should have a profit on that trade. But here's one thing that's really interesting is we never got to 47. The underlying stock that day ran up to 46.72. But honestly, I probably wouldn't have reacted until it at least got to 47 or a little bit beyond. And then it only stayed there for a second or two, and it ended up closing right around 46. But if you look at the chart, you see what actually happened. The next day, the stock jumped, and I have the percentage over here. The stock jumped 4 points, or about 8%. And I got to be honest, I scratched my head a little bit at this. At first, I'm like, did I get the earnings date wrong? And I pretty much knew that wasn't the case, but that was my first panic, if you will. And October 29th is the earnings date. It's after the market, so that was correct. So I had to kind of do a little bit of searching, and I found out that actually Snap was the reason why. Snap announced earnings, and I guess I would say that they're in the same realm. I don't necessarily think that they are. I mean, they both get advertising revenue, but I didn't necessarily think that good news by Snap would really drive Twitter's earnings or stock price on a off day. But the news in Snap was huge. So Snap opened up 25% from open to close after their earnings. So you see the big jump up here. The underlying stock, I'm highlighting it down here, is right about, where was that there? Right about 28, opened up somewhere around 35. So that was a huge move up. And I could see 25% jump in Snap could obviously move the needle on the Twitter stock, and it did. I mean, it made Twitter actually open 8% higher the next day. Okay, so now we got an issue in that we didn't have a chance to get out. We almost, based off of our plan, said if it got up to 47, we would just close the trade and we should have been profitable on it. But we didn't have that opportunity because it skyrocketed through that underlying. So I do say this is good news because we're supposed to be doing this on paper, and this gives us an opportunity to learn. So two things happened because of this earnings event and Snap being so good and driving Twitter stock higher, is that if we go and run straight to the quote right now on Twitter, we see that 49.59. So it's still above our price. So I got to go get a quote on it. So I run down and I look at, okay, what did we do on Monday? We looked at the stock's at 49.60 right now. We sold the 47 strike and we bought the 47.50. Now, we did mention that there wasn't a 47 strike in the month that contained earnings, the October 30th, or I should say the weekly that contained earnings. So we did a diagonal spread, or we probably would have looked at a long spread. Well, that kind of hurt us a little bit because it gives us a little bit, there's 50 cents worth of additional risk that we added to the position. And if we go down and we say, oh my gosh, I'm so worried the stock made that big of a move. Wow, it's at 133. Our entire trade when we put this on was trading for a net debit of 144 at the midpoint. We're down 10 cents. The stock skyrocketed through our short strike, and we go and we look at the underlying stock unexpectedly. I mean, obviously Snap could have affected Twitter, but not on this type of basis. I mean, a 25% jump in the underlying stock is an amazing move on Snap, which is really why Twitter would go up that amount. And so 130, well, right now I'm highlighting it's 134. So we're only down about 9 cents. So, well, how did that happen? Why did that situation occur that we were in theory a little bit wrong on our forecast? We were bullish overall, but we didn't want it to come that fast. We were hoping that we could make it till Friday today and that underlying stock would be below 47. Well, that didn't happen. Well, I noted from my screenshot that I took on Monday that the implied volatility on the option contract that we were buying was trading around an 80% implied volatility. Well, to go along with the Snap earnings, that added a little bit of risk into the underlying stock, and the implied volatility, which we did expect to go higher, also jumped with the stock price. So that went from 80%, and I'm highlighting this option right now, to 100% implied volatility. So that's the option contract that we own. The near-term option contract, all the time premium came out of it. Implied volatilities are going down in that underlying. So we're not as concerned about implied volatilities here. Bottom line is that jump in the back weekly that we own in implied volatility saved us. We're only down a dime on the trade. So what would you do? Close it and get out. Just move on with the trade. It went against you hard. I don't know if I wanted to continue to go. I got lucky. I looked at the trade. Maybe I fell asleep, not expecting Snap earnings to actually really affect my Twitter stock by an 8% overnight movement in that underlying stock. So if I did that, I would just look to get out of the trade. But I also considered another thing that we could do based off of this, and it turns out to work out not bad at all. And this is a trade that I have done a roll, I should say, that I have done on long calendars and on long diagonals, which that's what this trade would be, a long diagonal with calls on the bull side. We see the 47 strike in the short expiration trading at 262 by 268. If we look at the put side, there's no more time premium left. So this is deep in the money. The delta is 1. It is hurting us as the underlying stock goes up. We have a delta of 1 here. We have a delta of 64 here. So each point that it goes up, it's going to hurt us more. That short option contract is going to go against us more than the long option contract is going to help us. Now, that also means that if it goes down, if in a good scenario, it would go back down to 47, and that would be our best case scenario. But I don't want to take that risk. And we mentioned that on the Monday call, that if it gets to 47, we want to get out. We could lose a dime on this trade, close it out, and just look for the next event that we might want to participate in. Or in this scenario, and I'm going to show it to you one more time right down here, 131 right now, or we could clear out this trade and we could actually do what's called a roll. Okay, so this option contract would go away. We would buy to close this option contract, and going into earnings, we would sell an option contract, and here we need some time premium. So because vols have skyrocketed, 104 actually gone up since we've actually started this call. Overall, this is 151 now, this is 104, and we'll sell that volatility. We'll sell that 50 strike. So here's what the trade will be. We will remain long our 47.50 call option. We will then, I'm going to remove that, okay? But our trade would be that we would now sell that 50 strike and buy our 47 strike. And if I put this in the right rail, I'm going to adjust the trade so the vernacular is correct. So this would actually be a buy to close. This would be a sell to open overall. And we're rolling into a long call spread going into earnings. And right now we can get that done for almost a dime net credit. Okay, we could close out this trade and lose a dime, or we could roll into a long spread, give ourselves the potential to make the difference between the strikes, which would be 47.50 to 50, or 2.5 points, and receive a net credit to the account. So basically, we're just like, what happened here? We're going to get away with a trade that we were wrong on, in theory, because it moved too fast against us, and come out smelling like a rose here, in that we still have risk. We have the risk of the debit that we paid for it initially, which was $1.44, but we're going to roll into this long spread, not add any more additional risk, and give us the potential to make $2.50 on the upside, which is a little bit more likely now because the underlying stock has already gone through our strike price, right? So we're already there in that scenario. So time decay can just help us out. If the stock just stays where it's at and that option that we sold starts decaying, we might be able to get out of this trade at an actual profit to the trade just from time decay alone. So like I said, a very, very interesting trade. This is how we would roll it. We would buy to close the October 23rd option contract, sell the October 30th option contract, 50 strike call. Now remember, we're long the 47.50 with that October 30th expiration. Those two option contracts would combine to make a long call spread, and we could just let that trade ride going into earnings. We still have that net debit that we initially paid for it, but we actually upped it out. We brought a dime credit in by doing this roll. So a very interesting stock play of the day over time. And the whole reason why this trade works out is because we anticipated that the back month implied volatility would go up where we knew that the shorter term option contract was going to have a large rate of decay. So the fact that we set up the trade the way we did is the only reason why we have this opportunity to basically, we don't want the cheese anymore, just let us out of the trap scenario. All right. Well, that's going to be it for this edition of the Stock Play of the Day Overtime. On Monday, we'll be back with another edition of the Stock Play of the Day, but you want to make sure you click subscribe and ring the bell, and we'll see you this Monday at noon Eastern Time on the Ally YouTube channel. Thanks for coming, everyone.